to grow your business before you get listed. So this is the challenging part. Of course, the usual one, you can go to the bank and things like that. But I think that's especially if your business are in IT fields or whatever, in IT in the more specialized field, then it is not so easy to get from the local banks. So of course, over here you can see that there are certain a lot of things one can do. Over here, I will call this all as private markets, where you raise your funds from private, from private placements or from private markets. Some of it called private equity and things like that. Now over here, you have a lot of ways of doing it. Of course, it can start from angel investors, family and friends, or seed capital. But normally this part, we don't touch so much, in the sense that this part is a bit of much more riskier. We actually go into over here, which is, you can see, this is the part where it's either early stage or later stage, where you have traction with the company. The company is already in in the growth stage. So what you can see is that you can actually do a lot of things over here before the mezzanine stage, whereby the investment bankers, whatever, they come in. Before that, there's actually a lot of things can be done. You can either go through VCs, private equities, or a lot of other things. Private placements are all over here. Now, over here is also where a lot of profit can be made. If you can see that normally value creation over here is the steepest over here, the steepest value creation over here. So this is something very interesting for investors, and also something that is quite good for a lot of people who want to go for actually a better return compared to the general share market, right? So this is something quite interesting. So you can see that the private equity market trend worldwide now, if you look at it, more and more companies are actually going into PE-backed companies. Most of the more, you say the super rich or the big money or all these rich investors, they go into PE-backed companies more and more over here. You can see they are going into this rather than public companies, okay, because they see that there is opportunity over there. All right, so you can see the likes of those gigantic companies that we see now, like even Amazon or Google or even Alibaba. All of them actually went through PE back this stage, right? So you can also see in the sense that the what they call in the Asia Pacific itself, trillions are in this private equity. So you can see that more and more, okay, they go through asset management companies or all this, they are going into private equity. That means they go into companies before they get listed, okay? So this is actually a very huge market. So options available for raising capital or working capital, of course, you have the traditional bank loans and things like that. There's many things, crowdfunding, venture capital. I'll talk about some of these options. Of course, you can also get additional business partners if you want to, right? But it's not convenient for all businesses to do that. I mean, for practical stage, it's sometimes you cannot just simply get a business partner come in and then it creates a lot of issues, for the company. So over here, for me, I would like to talk a little bit more about private placements. Later, I'll talk about it, okay, whereby you can actually raise more if you go through private placement, but you need to know how to do it well. So over here, I like to talk about, there are a few options. One of them is equity crowdfunding, which is actually a kind of fintech kind of doing things, which is actually supported by Bank Negara. Bank Negara recently issued some equity crowdfunding licenses to a few companies. Generally what it does is that they go through online, and then they allow the crowd to come in and to buy into early stage unlisted companies, okay, as we mentioned, not listed market but unlisted. So they can actually get shares for the company, so for the company to grow further before it goes into listing. Okay, now over here, I would say that equity crowdfunding in Malaysia, if you look at it in the from 2016 to 2018, you find that they have done 51 until 2018. They have done 51 campaigns. They raised around in total in Malaysia, they raised around close to 50 million, 48 point something million for 50 companies. Okay, for successful. Some of the projects are not successful. So what happened is that you can see that most of the projects, most of the companies raise less than 500,000. So if you find that this is within your what you need, then it may be a good way to go about it. It's mostly retail investors. Our research also finds that most of them are actually young people who put in money. So if you look at overall 48 million for 50 companies, technically most of the companies raise less than 1 million per company. So it is not actually not a lot, but if your businesses thinks that it's good, then you can actually use this as an option, right? Of course, there's some cost involved, but I myself, I'm not into equity crowdfunding. It's just for information. But my general idea on this is that it is not very big. Generally, the investors mostly are young people, 35 years old and below. So what you find over here is that because they are using primary online method of doing it. So people who are like us, more than 35 years old and above, we do not really go into this kind of online platform, and many don't trust this kind of online platform. So the amount raised normally is not very big. Okay, it generally comes from the younger generation, the generation, sometimes we call it the younger generation, the millennials. So what happened is you find that their volume that they can go in is not a lot also, right? So this is some idea for everyone, but I believe in the future it will catch up, right? Now, there's another one that's quite interesting. It's called P2P lending. Peer-to-peer lending is actually more like a lending rather than a crowdfunding. So it's not, you doesn't get shares, you actually get, it's like instead of going through banks to loan, there are people who chip in to put in money to lend to SMEs, and SMEs actually get some loans from there. Now I have this is another kind of way of doing it. Okay, so borrowers goes direct to the lenders rather than going through a bank. Okay, so this is how it's done. Now, like to share over here is that in overall, you can see that up to 2018, there's already 6,222 successful campaigns, and they raised a total of 521 million. Right, total figure may sound impressive, but again, if you look at it, average out per company actually raised around 83 to 84,000 RM. Okay, so it's not a lot. It is good for small companies who need some short-term fund to fund certain, like for instance, it acts like a factoring or things like that. It's quite interesting in that sense. Again, most of those who comes in actually is age below 35, a lot of them, right? So the thing is not very high. There's quite a number of companies over here. You can see over here, there's many of them over here, right? Now, there's another market that is quite interesting. It's called lead market. Sometimes we refer it to as a third board. Now, of course, we have our main board, and then we have ACE market, which is sometimes called the second board, which is for smaller companies. Then you have lead market. Lead market is actually quite new, only 2017 that they introduced it. Lead market is actually for companies you don't even have to show profit. You can go into lead market. Okay, you don't have to have profit. But lead market has the good news is that you do not have to have profit shown profit over the years to actually go into lead market. But the cost of going into lead market is not low. It may cost you a few 100,000. Sometimes it costs you closer to a million. Whereas normally for listing, it can be 2 to 3 million, but this one, it can be close to 1 million. But the problem is that lead market is, how to say, it's not liquid. It is not as if like normal share market where it's very liquid, you can buy and sell very, the shares that after you list it there, you can only, lead market is only for sophisticated investors. That means people who are high-level individuals, things like that. So the market is not big. So if the market is not big, that means that buy and sell of the shares will not be that what they call liquid lah. Those is not liquid. So for certain we have actually worked with companies who offered to go to LEAP, but they eventually decided not to go because they find that the cost of going into LEAP market is quite high, and the amount that you can raise may not justify that. So hopefully the LEAP market will actually, they are able to either reduce the cost, or actually they make it more liquid, more people can go in, then maybe LEAP market will have more vibrancy, and then more people will go in. So for instance, like it's something like Nasdaq over the counter, something like that. It's not that liquid, but we are trying the government is trying to offer a platform for smaller companies to go in before they are profitable. So this is a commendable effort by the government, but they need more things to be done over here. So lead market, as I mentioned, it is more for sophisticated investors. Performance of companies sometimes, because of the smaller market, it is actually harder for you to value the shares and things like that. But it is a good way from graduating to ACE market and main market. But one of the things is that if you can straight go to ACE market, you will be actually have more liquid over there. Okay, liquidity. So today I'd like to share a bit more about private placement. Allow me to share a bit more about private placement. Now, private placement is actually a kind of what is called, instead of offering shares to the general public, you can actually offer it to, is a way for non-listed companies, not listed, to offer it to selected individuals or maybe corporations. So it is actually a way of doing it. So instead of doing public offering where you have to go through all the steps, you can actually try to do private placements. Okay. Now, so private placement is very interesting in the sense that if you look at the Capital Markets and Services Act 2007 and Company Act 2011, they actually, a company, if it's not listed, a non-listed company can issue ordinary shares and preference shares to selected individuals and corporations through a private placement, right? Now, if you are let's say if you have a Sdn Bhd, right, you can go until 50 shareholders. So now let's say you already have 5 shareholders. Now you want to increase another 45, it's actually very okay. You can actually just do that. But one thing is that you need to do private placement. You can talk to your friends, but you cannot do public. You cannot go public, right? That's very important. Now, if you were to go for more, let's say you want to go more than 50 because you want to raise more, okay, you want to raise more than 50 shareholders, right? So now, then you need to do a little bit more. You need to actually, you need to register as a Berhad, not a Sdn Bhd anymore, as a Berhad, which it becomes a public company. Now, that is very interesting in the sense that when it becomes a Berhad, you can actually you can actually lodge all your legal documents. We call it an info memo with the Securities Commission of Malaysia. Of course, you need to do all your financial, all those things that's required. You need a lawyer, you need COSACs and everything else to come in to do all these things in proper. You lodge all this with the what they call Securities Commission of Malaysia. Then you can actually offer whether it's ordinary shares or preference shares or even like other securities to the private market. Again, not to the public market, to the private market. Now, the private market over here means that high net worth individuals as defined by the Capital Markets and Services Act, okay, or corporations as defined by the law, okay. So all these things, if you adhere to it, you can actually do private placements. Now, for private placements, there are companies who raise 50 million, some raise 100 million, some raise 250 million. There are companies who have raised more than $1 billion, okay, through private placements, right? So these are actually a kind of options that you can do. You can actually, it's something quite interesting, but you need to do it right, all right? So this kind of, instead of like equity crowdfunding where the volume is normally small, private placement can go very big, okay? Can go very big. In terms of private placements, of course, you can do bonds, ordinary shares, or preference shares. Over here, I would want to highlight a special thing about preference shares. okay, which through our experience, we find that it is the most preferred type that investors will look at, right? Rather than ordinary shares. And it's also very important for the person who, for the companies who want to issue this to understand this too. Now, in terms of ordinary shares, as it is actually, you come in actually as a common shareholder, but that means that you are the ultimate shareholders in this sense. Now, as a shareholder, ordinary shareholders, you have all the voting rights that is accorded to a shareholders. So, of course, as ordinary shareholders, you also face higher risk, but you have what they call the ultimate responsibility for the company, as well as how to say, the most profit if the company actually have a very high valuation in the future. All right. Now, what I'd like to share over here is that for ordinary shares, what they call the for the company who issues ordinary shares, you have to make sure that if you have very diverse type of common shareholders who comes in, then you find that administration of the company may become a big issue. All right, you are talking about all these people. Every time you need to make a big decision, you have to ask so many shareholders. So sometimes it's not practical. Our belief is that it's not very practical to do ordinary shares, a lot of ordinary shares, to what they call the through private placements, because you need to hold AGMs and things like that. Yeah, so many things to do, and you may create actually a lot of decision making for the company becomes very troublesome. It might become the kind of problem, and if the people who come in later actually can amass enough shares, they may actually take over from the founders. Okay, so these are things that are concern for the founders, and also for the ordinary shareholders. Those investors who come in, they are also concerned about a very important thing, is about exit strategy. Now, one thing we talk about private placements, one of the biggest concern for investors is about exit. How do I exit the company, right? This is, I think, everyone's mind concern about. For instance, I can actually go into the company. Let's say we invest 100,000, 200,000 into the company. You get the shares, but what if the company are not able to go for IPO in time, right? There's a delay in the IPO. So how do you exit the company? That becomes a very troublesome thing. So that's why ordinary shares, our experience that it is actually not a very good way of doing private placements to raise capital, right? So there are problem for the investors as well as the shareholders, the ordinary shareholders, original shareholders of the company. So that's why preference shares becomes a very good option. So preference shares actually, they have lesser voting rights, not totally none, but lesser voting rights. But in replace of lesser voting rights, they actually get a fixed. You can actually fix a rate of return for preference shares, and at the same time, you can have what the most thing that they want is actually, if you do it as a redeemable preference shares, then what you get is actually a maturity date. So it acts like a loan. Okay. So for instance, you can say 5 years maturity date. So upon 5 years, the company, if you put it as a redeemable preference shares, the company, okay, is obliged to redeem the shares from the preference shareholder. So in that sense, you have a clear-cut exit strategy for the investors in the event that there is no IPO, right? So investors like it because now they have a clear-cut exit strategy. Their risk is actually so much lower now, okay, because the company will redeem it from them. So this is very important. At the same time, you can actually put it in your all the agreement to put it that there will be a fixed payment of dividends or things like that. So then the investors will have lesser risk. So the investors will come in return, they normally will be willing to actually forego voting rights, or lesser voting rights, are not totally, but lesser voting rights. So this will be good for the founders of the company, or the original shareholders of the company, because now when you make decisions for the company, you don't have to ask so many people, right? But at the same time, you can actually raise a considerable amount of shares from the market, from investors, and you structure it as if it's a loan, right? Because it is there's a maturity date. Okay, so in that sense, the investors get what they want because they get to a fixed return plus a maturity date that they can exit. Okay, but because it is a preference shares, there's also an option for the preference shares holder to actually cash in when there is a capital gain. Again, all this you have to structure it well, okay? Because all this is within the law, you can actually structure it well so that it is attractive for the the subscribers, the preference share subscribers, things like that. All right, so these are things that I like to share with everyone on private placement, which is a very interesting thing. There are many things that you can go about it. All right, so that's why redeemable preference shares, just as I mentioned, has a maturity date on which date the company will repay the capital amount to the preference shareholders. So after that, they can discontinue the dividend payment. You can actually put in periodic fixed payment of returns. You can fix maturity date. So all this and convertible, you can put in convertible so that you can actually convert into the ordinary shares when the time is right. That means after the company have grown to a certain level, you can actually convert them so that it does not dilute your shares too much to the what you call the original shareholders. Then you can actually, everyone can go for IPO. So this is actually a very flexible thing that can be done. So it can be done during the private placements that we know just now I mentioned. So just now I mentioned already is so RPS, it can be RPS or it can be RPSI. RPSI is actually Islamic, so you can actually go for Sharia compliance, especially in Malaysia. Sometimes you need to have Sharia compliance shares so that more people can come in, right? It acts like a loan to the company. So sometimes in certain countries, preference shares are called loan stock. It's a stock and also a loan, all right? So it's very interesting. Fixed rate return, no, it can be, you can do it in an annual return, quarterly payout, up to you, all right? And the shareholders actually get a certificate. And if upon maturity, you can say that, okay, upon maturity, they can get back in full of their redemption sum. Okay, let's say they come in, subscribing price is 100,000, the payout is also 100,000. So you can actually do that, right? It depends on the agreement. Okay, preference shares is also in a sense that if there is any problem with the company, preference shareholder, as the name preference means, they actually have preferred status. That means they have a higher claim compared to ordinary shareholders. Okay, so these are things that you look at. Now, in fact, if you look at during this pandemic, this is an interesting article that you can see over here that Bloomberg talks about how the ultra-rich families with cash on hand, they pour into private debt. So one of them is something like that. They pour into bonds and these were preference shares, because in the sense that it takes down their risk is lower, but they can still deploy the capital in an effective way. All right. So today I would like to take some time, a little bit small time of you to share about example that we actually have a company that that's doing this. We call it ADV perhaps, or Advanced Digital Venture perhaps. This company is the address is also in UA Business Park. It is a company, it's our principal company that we are doing the RPS, marketing the RPS for them. This company, it actually has a very unique business model. We call it the new business in the new normal, whereby it's actually combining groceries with financing. That means we call it money markets. So if you notice that if you go to overseas now, for instance, when I went to Taiwan, I noticed that the 7-Eleven in Taiwan, they are not only selling groceries or convenience items, they are also a pickup point as also a payment gateway point. For instance, people who go over there, I know the young people over there, after they go online and buy something, because they are normally not at home, so they ask the courier service to actually courier to the nearest 7-Eleven company. And then they, at night, after they go back, come back from work, they will go and collect over at 7-Eleven. But they will only pay during that time. That means they pay through 7-Eleven rather than pay online. So this is a very unique way of going about like how groceries can actually become like a financing point. Okay, so it's grocery is essential products, and money services are also essential products. So it becomes in a one-stop solution. It's something that is very, very special. So this company actually what it does is that it has four subsidiaries under it, each having individual business. For instance, one is grocery, the other one is money services in terms of remittance and currency exchange, which they have a license to do it, and also microfinancing in terms of lending, plus merger acquisitions. So this is a very unique combination. Why some people ask us why that kind of combination? As I mentioned, grocery companies can now act as actually a money services point, which is actually the future, right? It's a hybrid portion. So this company is you will see very soon that they are actually opening up, going to open up a lot of outlets throughout Malaysia. They are targeting within 5 years 1,000 stores. So in fact, groceries are very, very lucrative business, especially during this COVID-19 pandemic. Just to share with you a very interesting thing, in Singapore, there's a guy named Lee Hock Chi, and his wife are they own 61 stores in Singapore, and suddenly during this COVID-19 crisis they become billionaires. Singapore billionaires. Right, just having 61 stores in Singapore, they became billionaires during this COVID-19. A lot of people have problem with their business, but they actually become billionaires because the grocery business was proven to be actually very, very even they are very resilient. Even during COVID-19 crisis, they are still making money. All right. So also you can see over here is that Family Mart, which is owned by QL Resources, is showing you that they are each store can have up to 200,000 worth of revenue per month. So one thing why a lot of companies, in fact, a lot of listed companies or private equities go into groceries chain stores is because they generate a lot of cash. Imagine per store 200,000 cash. They collect cash, but they actually what they do is that they pay their suppliers in credit terms, 2 to 3 months. So there's a lot of cash in hand. So that cash in hand allows these grocery stores to do a lot of things. Okay, I will share with you a little bit further. So 7-Eleven have 2,000 over stores, Spin99 have 1,000 over stores, Family Mart have 100 over stores. Now, one thing that we find very interesting is that our Malaysian market is still under penetrated by groceries. If you go to Thailand, you go to Taiwan, you go to Japan, you find that their grocery stores are almost everywhere. Okay, but in Malaysia, you still don't see them everywhere. So there's a lot of place that is under penetrated. So there's a big market there. Before I go further, I'd like to share about one thing is that now grocery stores have a very unique sense is that they generate a lot of cash. Now that cash, traditionally, a lot of these grocery chain like Tesco and all these, they go and buy up properties. They invest in properties or go into overnight money market. Now, actually, you can do a lot of things with it. One of the things is that you can actually do money lending, micro lending with it. Okay, that's what insurance companies and banks does. When they have a lot of cash, they do money lending. So money lending can be done in micro sense. For instance, Aeon Credit is one of the key player. That's why they are Aeon and Aeon Credit. Because you have the cash, you can actually do lending as well. So you sell products and you do lending. It is a very good mix. Right, and you can see the net profit is 26%. It's very good. The other one is actually if you have the so that's why money lending businesses, online, offline, you can do a lot of things with that. Okay, another thing is actually money changing and remittance business, which again it is about cash business. So if you generate a lot of cash, you can do a lot of things. Now, furthermore, you can also do that's why you can see over here, new business, the new normal. If you have grocery chain plus you have money services, and so the new normal of grocery chain is not going to sell groceries only. They are going to have other services as well. They can become pickup points and become service point. They are going to sell a lot of intangible products, services. So it creates value for the grocery stores. That means a same overhead but more revenue. So this is a hybrid way of doing things, and you can add in fintech ecosystem. It creates a whole ecosystem by itself, which is very, very valuable. So we estimate all the business over here is going to have 14 to 19 billion in terms of value. So this is what we see. And of course, at the end of the day, it's about data that you collected. So if you have a grocery chain, you're going to collect data all over the country. So you are going to have very accurate data. So as what Jack Ma always says, now it's not about e-commerce, it's about data commerce, right? So finally, it is an ecosystem. It is an ecosystem that you build. So all of it, for instance, cash can be used for merger acquisition. You can actually buy up more chains, other chains, or buy up more businesses as well. So this is an example that I like to put in, is that if you know how to do private placement and things like that, you can actually get more. It's kind of like crowdfunding, but normally the investors are more sophisticated. They will put in more, and you actually have a much larger what I call pool of capital that you can raise, right? So this is a bit about what I can share with you. Hopefully this is informative for everyone. Thank you for your time, right?
All right, thank you for you guys spending your time with us. So thank you, Siu-Hock. Thank you for good sharing. Yeah, so we are very good, excited to know a lot of information from Siu-Hock. So I will run through some little bit here, and this is what I would very love to share all of you, which is the entrepreneurs. This we call Lee Ka-sing is one of the richest men in Hong Kong. All right, so just one minute, I will share for you guys. All right. Yeah, this is the one. All right. So he sharing a very good quote, which is build a boat, cross a river. Why not we just borrow a boat to cross a river? It's the same thing. So it's actually we won't spend a lot of time to wasting our time to build a boat. Yeah. So it's quite good quote for me. So all right. So another one. Thank you so much, you guys, spending your time with us. So hopefully you guys can get some information to how to expand your business, to run out more like working capitals. Yeah, so I hope maybe we can come up some Q&A. Any questions? So you guys can unmute yourself, and so we can try to answer you. All right.
Yeah. I have a question for Siu-Hock. You say that for preference shareholders you have slightly lower voting rights. So yeah. What do you mean by slightly
actually
lower
it's,
voting rights
okay,
compared to ordinary shares? Yeah, how different is that?
How different? Actually, you technically most of the things you cannot vote. What you can vote is only things that is actually like winding up the companies or anything that affects the preference shareholders' rights. Other than that, technically, you don't vote lah.
Oh, yeah. Okay.
So right. That's why it makes the life of the directors easier, so they can concentrate on growing the company rather than every time everything you have to go back to the shareholders and talk to everyone else. So it's not practical lah. No, if you try, imagine you have just 100 shareholders coming in, you have headache already.
Yes, you're right. Yeah. Especially when everybody want their view, want their way of doing things.
Yeah.
Then there's also this crowdfunding and all that. So crowdfunding is different, right? It's like they don't even have any rights at all. They just put money there.
Equity crowdfunding, I think, okay, to be fair, I'm not very well versed in equity crowdfunding. The thing they can do is that they mitigate on how they I think one thing, it depends on the total pool. For instance, you only put out, let's say, 10%. So no matter how they vote, it's only 10%. So you're not going to.
So now I understand a bit about private shares. I think the Jason, are you the one who told me about this ADV, right?
Yes. In the beginning.
They're going to open 1,000 stores and all. It's quite interesting combination. Having fintech ecosystem. Then obviously when you have a lot of cash flow from retail, you use the money for something else. It makes a lot of sense. Yeah. So okay, anyone else? I can mute myself now.
Maybe we go since now it's almost 4:45.
Yeah.
All right. Any else? Anyone would like to ask a question? Can just unmute yourself.
So when you do the pref convertible, redeemable convertible shares, the net result is you put yourself out of the loan market from banks. When banks see you have a RCS, they tend not to give you any.
The whole idea is you find that banks, of course, they can give you loan, but if you choose RPS, normally you are not going to tap into the bank market through. But it depends on your strategy, what you want to do.
Basically, what I'm saying is that if you have one, then you can't have the other. So it's not like
it depends at the end of the day how big your assets are also, actually. Now, if you're able to build assets to very big, I think you can do a lot of things. Ultimately, it is actually how big your assets can become.
Normally, at this stage, you are not that big yet.
Yes, true. So I think for a lot of entrepreneurs, I think this is what they call RPS makes sense. And you see, what happened is this. Now, RPS is structured in such a way that you only pay the dividend amount during this, let's say, 5 years. Then you only pay the whole capital amount at the end of 5 years, for instance. Compared to what you have bank loans, normally you are servicing the capital plus the interest together. So the outflow of the cash flow is actually higher. Now, if you calculate everything else, actually the end result is more or less the same, the effective interest rate. So there's a reason why if you are able to do RPS, it actually makes more sense because your cash flow, you are there. Let's say you raise, say for instance, you are able to raise 50 million. 50 million is there with you for 5 years. Rather than in a loan, you take 50 million loan, the next month you're starting to pay out the capital with the interest.
Okay. Legally, the repayment of RPS has to be from new funds or profit. You can't get anything else. If you don't get your profit within X years, you're having trouble with the RPS.
Actually, there are ways of how you define. That's why it depends on how you write your IM. Now, if you write your IM properly, you can actually do partial redemption. That means you can make sure that even, let's say the first 1 or 2 years, your profit may not be enough to cover the return. You can actually write it in such a way that you can also do partial redemption. That means at the end of the day, you can still pay out. So it's legal. There are a lot of companies who did not foresee this. That's why they go into trouble because they actually put in only dividend. That means they will have problem. But you can also do cumulative. Cumulative means that if first year you cannot pay, then you can accumulate into second year and you pay both years together. So there are many ways of going about it. It depends on the IM. It's very flexible, but you need to talk to the finance people and the what they call the lawyers carefully, because once you lodge with Securities Commission, then it's there. You have to adhere everything to it, or else the directors are liable.
So at this stage, we're not into Security Commission yet, right? We just basically private.
It depends on how big you want to go. Let's say normally if you want to go bigger, it's better. It's good to actually lodge with Securities Commission. But if you are only doing, let's say, you're only getting 10, 20 people to come in among your, a very small group of people, then I think it is. You can always issue, whatever. You just go to your COSEC and then you just issue whatever you want, just like normal companies, what they do. But if you are talking about bigger amount and you are going to issue prospectus, for instance, we issue prospectus.
So I think at this stage, SME and private proprietor prefer not to do prospectus and IC because it's become quite onerous. So they go to people like you to raise.
We do also do prospectus.
I know you do, but I, as an entrepreneur, I don't want to do prospectus because I have to commit to many things, right?
Oh, it depends on the fund size that you want, I would say.
After you do prospectus, you still don't get approved because not necessarily you get approved.
No, actually, if you do it well, there's what we call with SC. There's a part what we call you lodge and launch. So technically, you lodge with SC, and normally they would not go and unless there are very erroneous things inside lah, if you actually go through proper COSEC and lawyers to do everything for you, you're able to go lodge, and then you're able to lodge.
That's the problem. When you work proper, you go to a lawyer, you go to people like you want to make sure everything is in order before you can even.
Of course.
So
it is a requirement, yeah.
The benchmark is at your side. So that it's not as easy as what we say can be done, but because you are worried that you also get punished by SC, likewise a lawyer, so you have to be even more careful. So that's saying and doing two different things.
I mean, it's options lah. We say it's options to, like, for instance, it's options of every company.
Sure that you have to make sure that it's above par at least.
Yes.
Bogeys and all, birdie.
Of course.
Given all that, the next question is, in using your service, what are your charges?
Oh, all right. I think.
How do you charge? Yeah.
Okay. This is more for a case by case basis lah. We are again. We don't have a standard rate. It depends on the project. It depends on a lot of things. But I would say that we currently actually we are quite full with whatever project we have. So we are not accepting any new projects at this point of time. But it is actually case by case. It depends on the project, whether what are the things that we need to do. So it's no hard and fast rule.
Say I capital of $1 million. I want to raise 3 million. How much do you charge? How do you charge?
3 million.
Because for the lead market, the financial, all the fees come to almost about 1 million.
Yeah, true.
If I raise 1 million, I pay. There's nothing
true,
left.
True. That's why lead market. In the past, our experience that is simply not worth it lah.
Yeah, it's not worth it because the value is not enough.
Yeah.
In the case of not lead market, like this current situation,
if you're talking about 3 million, you can actually go for equity crowdfunding. I think on their side, they are more or less, they can still handle the account amount. We handle bigger amounts.
Basically, they're willing to do 3 to 1. That means
I think if you look at the average size of what ECF does, it's around there. Equity crowdfunding is around there.
Okay. Yeah. All right. Thanks a lot. I won't take up your time. That the others ask.
Yeah. Okay. If everyone don't have actually any other questions, maybe next time you can actually talk to Jason. Jason will be able to answer you. Maybe during one of your golf outing, as you play golf, you can talk to him, right?
Yes.
So I wish everyone best of health. So hopefully next time, if I'm KL, I can meet up with everyone over here. Okay, thanks for giving me the opportunity to talk to you all. Thank you very much.
Thank you, Daniel. Thank you, everyone.
Hey, thanks.